What is up, guys? Welcome to a UCAD trade breakdown, and let's dive right into it. All right, so as always, I'm going to look at the economic calendar first before I even open the charts, right? So I'm going to take you through my process right here. On Sundays is when I get ready for the week. And first thing I do is open Forex Factory and check out the economic calendar. So this is actually this week. Let's go to last week's. As we can see, Monday, Tuesday, and Wednesday had no red folder news. The economic calendar is your roadmap. What does that mean? It's going to tell you what days you could trade, what days you can't. Monday, Tuesday, Wednesdays, for my system, for my strategy, I'm not going to trade. It might be different for you. You might have a different system. But for me, I'm not going to trade because for me, I'm looking for highest probability expansion days. Monday, Tuesday, Wednesday lack red folder news. The expectation in my eyes is that they are going to lack the energy and volatility price needs to get to its objectives, to get to its draws on liquidity, okay? Thursday and Friday have red folder news. So my expectation coming into this week is Monday accumulation, Tuesday accumulation, Wednesday accumulation, Thursday manipulation reversal down into a Friday expansion. Okay, that is my expectation coming into a week like this, where we have no red folder news to begin, and then Thursday, Friday we do. All right, so that is my expectation going into the week. I already know I'm not going to look at trades. I'm not going to look to trade Monday, Tuesday, or Wednesday. So with that being said, let's just dive right into the charts. As always, I'm going to look for higher time frame context. Now, what does that mean? For me, that's simply ERL to IRL or IRL to ERL. If you don't know what that is, IRL is internal range liquidity. It is a fair value gap or an efficiency. ERL stands for external range liquidity, which is simply a swing high or swing low. Right here, we have our weekly IRL, that weekly fair value gap. The expectation is for lower prices. We have bearish order flow here. Expectation is for price to continue lower off of where? This fair value gap towards what? This external range liquidity, right? This is the context. This is where you're going to find your lower time frame market maker sell models. Okay. So our context is established right here. And I'm looking for these contexts on the monthly, weekly, or daily charts. Now I get a lot of questions going over how many pairs I'm watching. Right now, I believe I'm watching about 27 or so. And people ask, well, how can you keep track of so many pairs? Well, it's very simple because the higher time frames take a lot of time to develop, right? Because I'm looking at the monthly, weekly, or daily charts. If I only looked at two pairs, like maybe ES and NQ, I'd be waiting a long time before something clean sets up. And I'm very picky with the things I'm looking for on these higher time frame charts. It has to be super clean. It has to look textbook. It has to stick out like a sore thumb. Okay, so over here on UCAD, we have a very nice setup. Okay, we have this weekly internal range liquidity to external range liquidity. The context. So with the context now being established here very clearly, we can now dive into the 4-hour chart. Why? Because that's the time frame alignment we're using. If you didn't know, from a weekly chart, you want to go into a 4-hour chart and look for a 4-hour fair value gap displacing away from this level. And that's all I'm going to look for, okay? It's very simple. Go from a weekly level to the 4-hour time frame. So here is that 4-hour chart. And as we can see, we have that 4-hour fair value gap displacing price away after taking this liquidity right here into this weekly fair value gap. That's internal range liquidity. There is our 4-hour fair value gap. That is going to be the PD array we're going to frame a trade out of. Okay, so this is part 2. Part 1 is establishing that higher time frame context. Part 2 is establishing that PD array we're going to look for an entry out of. That PD array is usually on an intermediate term time frame, which for me are the 4-hour charts and 1-hour charts. So right here, since we're working off of a weekly level, we're going to look for a PD array, a 4-hour PD array, to frame a trade out of. So here is that 4-hour fair value gap. Now we want to dive into the 15-minute chart and look for a fair value gap there, okay? Because from a 4-hour chart, we can go into a 15-minute entry. And if we can't find that 15-minute entry, like I'm going to show you in the next time frame, once we drop down, we could even drop lower into the 5-minute, okay? Now, I'll show you right here. Go into the 15-minute. Let me clean this up. I did that for the Twitter screenshot. So we have that volatility injection right here on Friday, as we can see. That was PPI 830. What we could also see is that on Thursday, we had that CPI volatility injection right here at 830 as well. That was that manipulation. Remember, I was expecting manipulation on Thursday? That's that manipulation that I was looking for, right? Because what happened Monday, Tuesday, and Wednesday? Consolidation. We went nowhere. We went nowhere. We were just consolidating all throughout then, up until this point right here. So this is that accumulation, manipulation. What I wanted to see what I wanted to see happen on Friday was further continuation lower, that distribution. That didn't end up happening right here. We actually displaced up higher after taking that 4-hour external range liquidity. But that's besides the point. That's not the trade I'm trying to review right now. Let's review the actual trade right here. Okay, so going into Friday, which is right here, we had that 4-hour fair value gap, remember? Now, all we're looking for is a 15-minute fair value gap. So here's that 15-minute displacement via a fair value gap. I'm looking out of that 4-hour fair value gap, okay? Now, I got so many questions asking me, why is this a breakaway gap and why did I expect price not to fill this? Why did I come down into a 5-minute chart and enter down here this deep in a discount and not wait for a retracement to then go lower? Now, it's as simple as this. You see the low of this candle right here? Do you see how? Let me move right here. Let's go into replay mode. So this is what it looked like at the time, right? Do you see how aggressively we closed below this low? Do you really think the most probable thing for price to do at this point, once this candle closes, is to retrace all the way up after being so close to the drawn liquidity here, after being so close to our target, going all the way up here to then go down? No, that's just not likely. And that would actually be quite unhealthy because we are so close right here. We have so much energy towards here. That's just not likely. Now the trick here is this close below told you everything. That close made this a breakaway gap. Because if this candle failed to close below it, I wouldn't consider this a breakaway gap, right? Because if we decided to wick, then I could see the possibility of going up here to go down. But it's the fact that we closed so aggressively below it that gave me the indication that price does not want to come up here. It does not need to do that. Okay, so just this, the close below this candle right here, told me that this is a breakaway gap. Okay, so once this occurred, I knew I couldn't use this as an entry. So I dove into the 5-minute chart and looked for something there. Now, on this 5-minute, what do we see? Well, we see the formation of this 5-minute fair value gap right here. We also have this 5-minute order block right here. Okay. So keeping in mind that the expectation is for this not to get filled. We don't need to retrace all the way back here before coming down into this 4-hour external range liquidity. Okay. It is within that idea that I wanted to take a trade off of this 5-minute PD array, off of this 5-minute fair value gap. Okay. And at most, don't want to see it go above this order block. I want to see this get respected. I want to see this fair value gap get respected. So what I did is I set a limit order right here, the top of this candle, which is basically the low of this fair value gap. Okay. So my order goes there. My stop loss goes above this order block. Why? Well, at most, I want to see this mean threshold get respected. Once we start closing above it and messing with the top of this order block, I want to be out because... So I failed to properly explain this in the original recording, so I'm going back and explaining it right now. So the reason I'm entering off this 5-minute fair value gap here and not off of a 15-minute array is because you can have two different ways of entering off of a 4-hour fair value gap. Okay, so like I said, we had that 15-minute breakaway gap, which I didn't expect price to come into, and I knew that the only way I would have been able to play this is if I dove into a 5-minute chart and looked for the second entry model. Okay, because there's two different ways you can enter off of a 4-hour fair value gap. It doesn't just have to be a 15-minute FVG. You could also enter off of a 5-minute fair value gap on a second high probability leg. Now, what does that mean? What's a high probability leg? Well, essentially, it just has to contain a fair value gap, right? A leg is this swing high to this swing low, and it must contain this fair value gap, right? So we hit the higher time frame PD array. We have this original high probability leg right here. So here's your first 5-minute fair value gap in that high probability leg. We could enter off of the formation of a second 5-minute fair value gap in the form of a second high probability leg. So we have that right here with this swing high, with this swing low, and this retracement right here to this fair value gap is an entry. And you can place your stop loss right here above that swing high. That's the safe spot, right? But for me, this wouldn't give me the proper RRs. So I can move my stops a bit lower to another valid level, which would be the high of this order block body, giving me that desired 2R that I am looking for. Okay, so I'm playing this leg right here down towards this 4-hour external range liquidity. So that's the reason I could enter off of this 5-minute fair value gap instead of waiting for a 15-minute array. It's simply waiting for that second high probability leg on the 5-minute chart because you're demanding more confirmation by going down into a lower time frame off of a 4-hour array. So instead of using that one fair value gap in the 15-minute, you go down into the 5-minute and look for that extra leg because you were looking for extra confirmation. All right. So credit to Arjo for this entry model. I learned it from him. Big shouts. I always give credit where credit is due. So yeah, this is essentially the ST model on the 5-minute chart, that double ST, which we're waiting for that initial high probability leg, that initial 5-minute fair value gap, and then that second fair value gap in the form of that second high probability leg. So now I have my entry, I have my stop loss, and I have my target fixated at this strict 2R level. As always, that's where I like to target. What I like to do sometimes when I have high conviction on the play is I'll scale 80% at 2R and then leave 20% for final targets. All right. But over here, I knew the market this week has been very, very low probability. It's not been the nicest price action. So I didn't trust it on having a large run below it. So I decided to just take it all off right here. And basically, let's just see how this trade played out. There's that retracement into it, to that fair value gap. So now we're in the trade and boom, that's it. Simple as that. So to wrap things up here, it is simply a 3-step process. You're going to need that higher time frame context, which is on your weekly, on that monthly chart, on that daily chart. You're going to have that intermediate term time frame PD array via your 4-hour or 1-hour charts. In this case, we had this 4-hour PD array, 4-hour fair value gap to frame an entry out of. And then you're going to get your lower time frames to base your entry. So in this case, I expected this not to get retraced towards. So for that reason, I dropped into the 5-minute time frame and looked for a PD array down here to base a trade out of towards this external range low. And this is the lower time frame entry PD array that was used. This 5-minute fair value gap towards these 4-hour external range lows, targeting a fixed 2R. Very simple. Price and time are aligning right here. And I hope you learned something from this. I'm going to look to upload some more of these as the year goes on. So if you enjoyed it, please subscribe and thank you for watching. Have a good one, guys.